All right, let's dive straight into this explainer and unpack the massive hype currently surrounding artificial intelligence and the global economy. I mean, if you've been watching the markets, reading the news, or honestly just existing in the world lately, you know that AI is being hailed as the ultimate economic game changer. But what if the financial reality is actually entirely different from that mainstream narrative? So if AI is practically guaranteed to change the world, and let's face it probably is, we really have to ask ourselves, why might buying the biggest tech stocks actually be a bad strategy for your portfolio over the next decade? It sounds completely counterintuitive, right? But recent research from Vanguard and industry data from the semiconductor space suggests that we might be looking at a major paradox here. A booming AI economy does not automatically equal booming tech stock returns.
Section 1. The macro reality and the sheer scale of AI infrastructure.
To separate the actual economic reality from all the stock market hype, we first have to wrap our heads around the staggering amount of money being spent right now to build AI's foundation. We are witnessing an unprecedented phase of capital deepening. That's essentially a massive wave of investment to dramatically increase our technological capacity. Deep-pocketed companies known as AI scalers, thank the massive tech and cloud giants, are committing a historic $2.1 trillion to infrastructure between 2025 and 2027 alone. That is a colossal amount of capital being injected directly into the physical hardware required to make generative AI a reality. Now, you might be wondering, how do you spend $2.1 trillion without totally destroying your balance sheet? Well, these tech giants are leveraging multiple financing channels to maintain their multi-year earnings growth trajectories while funding this massive expansion. They aren't just using cash. They're using leases, tapping into public and private credit markets, and deploying some really creative vendor financing. They are keenly aware that Wall Street expects their earnings to keep growing, so they're becoming extremely astute operators of their funding capacities.
This parallel is absolutely fascinating. It brilliantly illustrates how today's AI investment perfectly mirrors the highly physical infrastructure booms of the past. Notice how the current trajectory of AI investment tracks almost identically with the 19th century railroad expansion and the 1990s telecommunications surge. Whenever a new general-purpose technology emerges, the economy has to spend years deeply investing in the new physical tools, laying the digital train tracks, so to speak, before the real benefits are felt.
And here is the crucial part. Despite the wall-to-wall media coverage making it feel like AI is literally everywhere already, we're actually much closer to the beginning of this infrastructure cycle than the end. Vanguard's data shows we are only at about 30 to 40% of the peaks we saw in those previous historic buildouts. The heavy lifting is still actively happening right now.
Moving on to Section 2, the physical AI infrastructure and powering the next generation of data centers.
Let's move to the actual hardware. AI isn't just invisible code floating in the cloud, you know? It requires massive amounts of electricity. As data centers transition to higher power densities to support AI, there is a sharp increase in demand for highly specialized power conversion and management solutions. We're talking about advanced materials like silicon carbide and gallium nitride, which can handle extreme heat and power far better than standard silicon. Add in intelligent power modules and next-generation 800-volt power systems, and you quickly realize the physical constraints of powering these data centers are becoming just as critical as the software itself. To put all that physical demand into perspective, let's look at the component makers themselves. For instance, ON Semiconductor, a major player in this space, actually expects their AI data center revenues to completely double year over year in 2026. That is a staggering growth rate, and it's driven entirely by hyperscalers rushing to build out their AI server capacity, which absolutely requires these physical power chips to keep everything running without melting down.
Okay, Section 3, a universal productivity boom and how AI diffuses across the economy.
So the builders are spending the money now, but who actually benefits later on? Well, Vanguard's task-based framework shows us that AI's potential to streamline rules-based cognitive tasks is surprisingly universal. It is not just for programmers or copywriters. Even in industries traditionally seen as highly physical, like manufacturing or transportation, a massive amount of time is spent on rules-based tasks that current AI tools can dramatically accelerate. It brings productivity gains to almost every single industry by freeing up human workers for higher-value activities.
As these tools really spread out through the economy, and companies learn to integrate them into their daily workflows, the macro impact could be huge. we could see U.S. real GDP growth surge to roughly 3% between 2028 and 2035. To put that into context, the average over the past 5 years has been around 2.4%. That jump represents literally trillions of dollars in new economic value, created purely by working smarter with AI.
There is a catch, though. To actually hit that 3% economic milestone, AI capabilities will need to scale up to augment roughly 30% of total working hours by 2035. Right now, Vanguard estimates we're only at about 12%. So the path from here to that universal productivity boom requires a massive, successful adoption curve across everyday businesses. It's totally feasible, but it's definitely not guaranteed.
Which brings us to Section 4, the counterintuitive investment playbook, expectation versus reality in the stock market.
All right, here is where we arrive at the big twist. Why a booming AI economy does not automatically translate into booming tech stock returns. This is where we have to separate the company from the stock price. The biggest tech companies are doing great business, absolutely, but their stock prices have already priced in a flawless future. Because the earnings expectations for big tech are already so incredibly high, they may actually struggle to meet them. Plus, investors tend to underestimate creative destruction. That's the reality that new entrants will inevitably disrupt the current leaders, eroding overall profitability. Because of all this, Vanguard forecasts that large-cap tech companies might only deliver returns of 4% to 5% annually over the next decade.
History teaches us a really vital lesson here. Past technological revolutions show that the most obvious investments aren't always the most profitable ones over the long haul. Think about it. The companies laying the train tracks back in the day didn't necessarily make the most money. It was the businesses that used the railroads to ship their goods faster and cheaper that really won out. So, the data-driven playbook actually points away from that crowded tech trade. Over the next 5 to 10 years, Vanguard projects the best risk-return profiles lie in high-quality U.S. fixed income, U.S. value-oriented equities, and non-U.S. developed market equities. Let's break down exactly why that is. First up, high-quality fixed income. It acts as a crucial defensive play. Thanks to higher neutral interest rates, bonds are providing compelling real returns right now. But honestly, more importantly, they offer vital diversification. Vanguard calculates there is a 25 to 30% chance that AI actually fails to deliver that higher economic growth we talked about. If the AI revolution stalls out, you're going to want the steady, reliable returns of high-quality bonds holding up your portfolio.
Furthermore, value stocks and international equities stand to benefit the most as this cycle matures. Why? Because they are the ultimate consumers of the AI technology. When the massive investments in AI infrastructure finally translate into everyday tools, it's the standard, value-oriented businesses, your banks, your manufacturers, your retailers, that will actually use those tools to cut costs and boost their profit margins. They are the ones who capture the ultimate productivity dividend.
As we wrap up this explainer, I want to leave you with this provocative thought. If the stock market reality of the next decade is completely flipped from today's mainstream expectation, how are you positioning your own investments? Are you chasing the crowded infrastructure builders whose success is already fully priced in, or are you preparing for the quiet, widespread productivity boom that will reward the everyday businesses of tomorrow? Something to really think about as you review your own strategy.